Hello there. Welcome to June 2025 market recap with BlackPoint Capital Partners. Today, you'll be working with Nico Mauricio, myself, one of the founding members and managing partners of BlackPoint Capital Partners, where I lead BlackPoint's investment committee and oversee portfolio management across the firm. Where BlackPoint Capital Partners, we specialize in cross-border financial planning and international wealth strategies across the globe and in multiple currencies. We also have on the call today Arun Kaul, OCIO, Outside Chief Investment Officer. And Arun brings nearly 30 years of investment experience across equities, fixed income, alternatives, and hedging strategies. He's a former CIO at a $2 billion consultancy and chief strategist at a $4 billion advisory firm. And he supports BlackPoint's investment policy and portfolio strategies for the firm. For today's call, we're going to go through a few things. First and foremost, a mid-year market checkpoint, where we're going to go over key themes and performance drivers for the first half of 2025. Rising market concentration across the S&P 500, central bank gold buying trends, the Fed's policy path, and we're also going to review the second half of 2025 and some portfolio implications for the firm itself. First and foremost, want to get a bit of a health check, if you are, gauge as to where we're at for the first 6 months of the year. First 2 quarters now are officially in the books. And what you see here is a few different asset classes. We have the S&P 500, the MSCI ACWI, which is the All World Index, the gold exposure there as well, and the Bloomberg Ag. As we can see, since the beginning of the year, gold has been a strong outperformer with almost 27% total year-to-date return, whereas the S&P 500 is just around that 6% mark, and the Bloomberg Ag right around that 4% mark. Overall volatility across the asset classes, we see the S&P 500, it is kind of on the lower end of the overall performance, but the volatility is slightly spiked against other asset classes, whereas if we see on the other end of the spectrum, the Bloomberg Ag is right in line with fixed income and where we see that moving forward. So just now that we've taken a look at where we're at from an asset classes and just kind of reviewed the first 6 months of the year, Arun, I'm actually going to ask you this question here at this point in time. It seems as though market concentration has a bit of a risk right now. If we look at the S&P 500 versus other asset classes, it seems to be relatively volatile and not necessarily seeing the same rewards that we've seen in the past. Any thoughts on that there?
Yeah, so we certainly had that larger drawdown this year in April post the tariff, the post-Liberation Day, the tariff announcement. So we've seen higher volatility this year from the S&P, in part because we had an almost 20% drawdown back in April. So that's certainly been part of the volatility. And then the second part, just on concentration, and this has really been a trend since 2017 or 2018, where a handful of large firms such as Microsoft and NVIDIA, Apple, Google, and Meta, and other names have been a significant share of the market weight of the S&P. So that handful of names, the Mag 7, has been a dominant driver in the performance of the index. And again, especially off the bottom post-April, and then certainly when we had the strong correction after the draw in 2022. So this will cause volatility in portfolios, given that 7 names are such a large share of the overall weight of the S&P.
Great. And so just on that, a couple of other things. We also saw the big difference in the overall performance of gold to the S&P 500. So we understand a little bit of that market concentration risk. Tell us a little bit more about gold and some of the buying signals that we've seen from the Federal Reserves across the globe.
Certainly. So we've definitely had higher inflation, which has been one trigger to support gold. And we also had the U.S. and effectively some of the global powers freezing Russian assets inside the banking system when Russia invaded the Ukraine. So that was about $300 billion of capital that was event, we have seen central banks globally across the globe start to add to their gold reserves. And that's what you're seeing in the last three bars in this graph, is that central banks have been diversifying their portfolios and in part trying to offset some of their exposure or risk, hedge some of their risk to the US dollar. So gold has been a beneficiary, the main beneficiary of that, as we're seeing with its current pricing at all-time highs, and certainly significant amount of buying from global central banks adding to their gold reserves.
Great. And just one last question on that. Do we think that that's going to continue moving forward into the rest of the year?
I think that continues in part because the move to freeze Russian assets was quite an aggressive move from a geopolitical perspective. And we still have concerns about inflation. And we have some concerns about the US dollar in terms of deficit spending with the recent budget. So I think we still have the backdrop that is supportive of gold. May not be as strong as it was the last couple of years, but it's still quite supportive of gold and gold prices.
Okay, and I think that leads perfectly on to the next slide here. When it comes to the deficit that we're currently facing, obviously the Federal Reserve has had a few policy missteps, over the past few years. Could you tell us a little bit more about that and how that's maybe impacted the markets as we see today?
So it's a good question, and I think policy missteps is a good way to put it. So the Federal Reserve effectively oversaw the largest growth in money supply ever during the 21-22 period. It was far in excess of what we had in the 1970s. They've also failed to meet their policy goal of inflation of 2%, a lot more than the last 4 years. And this particular chart here shows inflation, and it shows their measure of QE, their activity in QE. And what we saw is that even as inflation was rising above 5%, the Federal Reserve was still buying assets and adding to their balance sheet, which was effectively a form of loosening monetary policy. So they had very loose policy, even while inflation was at 4 and 5%. So all of that in combination has helped drive inflation higher, and in part has been the reason why we've had a harder time, or it's taken longer to get inflation back to target.
Great. And I just one last question on this particular slide here, Arun. We see here consistently failed to meet inflation targets over the past few years. Do you think that that's going to continue potentially moving forward with the current administration on that side?
So that's really the challenge in terms of where the market is at today. So we're seeing much more animated discussion around the target. The Federal Reserve is saying they're concerned about tariffs and the impact on inflation. And the administration is arguing that inflation the last few months has actually been quite low if you measure the monthly level. And that overall their policies are helping to lower inflation and to increase growth. So it looks like we're going to start to see some cuts later in the year. But the argument is from the administration is that Powell is too late, and that's his new nickname is, I believe, Too Late Powell from the administration.
Yeah, exactly. And I think that's, the perfect segue here. Obviously, we've seen in, Twitter, on the news, Trump has consistently called Powell, Too Late Powell. Recently saw that, the printout that he sent over to Powell, put it on his desk where it shows the interest rates effectively. What's the case for keeping Powell in place, and is there a case to maybe remove him or take him out of place?
Yes, I think if you look at the overall track record, and this particular chart looks at the losses for the Federal Reserve. So if you look at the overall track record, I don't think it's a strong track record. I think you could argue that he can be removed for cause, given that the money supply growth was so extreme. Inflation hit 9%. We've been off target for 4 years, and this chart comments on the losses the Federal Reserve has incurred on their balance sheet. They've now lost over $230 billion in terms of financing and net interest spreads on their balance sheet, which means that they're paying out more in interest on reserves than they're earning on interest from their holdings. Now, in a normal bank, if you lose that kind of money, you'd have to go back to capital markets and re-equitize your balance sheet. You'd have to raise equity. For a central bank, they don't have to do that, but they have the same P&L accounting as a normal bank. So it's pretty hard to defend losing $230 billion. And this money is actually remitted to the Treasury, which, as you can see, they've always remitted money the last 20, 25 years. and they have not been for the last 2.5 years because they're losing money.
Wow.
Uh,
And so I guess the big question there is if this was a private entity, if you will, it sounds like a CEO losing that much on the balance sheet over a period of time, we'd most likely see them on their way out, right? I think that's the big takeaway from a private to versus public sector, huh?
I think it's a fair comment. Yes. So, you would see that CEO under severe pressure. I don't believe the administration has any intent. I think it's quite clear to reappoint him. I think it's potential that the administration will try and appoint a shadow Fed or just always be at the side in terms of being quite aggressive with where they think policy should be. The administration suggested the rate should be 1 or 2%. I think that's too low, but they're probably correct in that rates should be lower than where they are now, which is around 4.25, especially given inflation is about 2 to 2.5 to 2.3 on our forward expectations.
Great, great. And so, what I guess the next big question is obviously we understand there's just some turmoil from the Federal Reserve, things of that nature. But what does this mean for the portfolios? What does this mean for markets? How do we navigate this moving forward?
So we have definitely added on our side and with a lot of our clients to some real assets. So we've seen higher inflation. We're seeing gold do fairly well. So certainly real assets tend to perform better in periods of higher inflation. So even though we have uncertainty on the inflation going forward, there's still a lot of money in the system. And we have still significant amount of potential deficit spending coming from the U.S. federal government with the current, I guess it's the one big beautiful bill, which is almost passed, but not quite.
Mhm.
So gold, infrastructure, hard assets, sometimes commodities, and certainly real estate can act as good diversifiers in a portfolio and can certainly hedge against inflation.
Great. And I think we've also made a big shift as well, prioritizing risk managed assets from an equity exposure side. What does that mean? Basically, we've increased some of that quality, higher quality businesses. Is that correct as well from an equity side of things, Arun?
Yeah. So, and part of that concentration risk as well, those firms that have been the highest exposure of the S&P are quite high quality businesses. There's some concern about their valuations, but definitely, yes, agree that the higher quality business with the better balance sheets, given that rates are higher, they have a better ability to navigate through and manage the balance sheet, manage the interest rate costs from their operations, and maintain some margin. So higher quality, I think, still makes sense. And we have certainly seen some stress for areas and sectors that have higher exposure, higher debt exposures, and higher interest rate costs.
Great, great. And then, so obviously, we've got a big takeaway as to what's happened in the first half of the year. A few of the things to keep an eye out for from a Federal Reserve perspective to just the markets as a whole. So, looking forward to the rest of the back half of the year, big question to you, Arun, is well, do we think that the Fed is going to cut rates in Q3 or Q4? What's the expectation there?
I think the expectation is the Fed cuts 2 to 3 times. They're under pretty significant pressure from the administration and just in terms of the general backdrop from most strategists. So right now, the expectation is that they would do 2 to 3 cuts, which would take us from around 4.25 towards 3.5.
Okay. And if interest rates do decide to come down, obviously we're going to see a big shift. Money markets aren't going to pay as much. High yield savings aren't going to pay as much. Where should we start to look at to deploy some of that cash moving forward?
So certainly private credit is an interesting area. Your investors receive approximately 500 to 600 basis points of spread above short-term rates. So even if rates are reduced to 3.5, you can still make 8 to 8.5 to 9% in certain private credit strategies, in particular direct lending. So that's an area that's of appeal, I think, to many investors. And there's much greater access, much higher number of access points to a lot of those strategies, and they're now available as interval funds as well, which have preferred liquidity. So certainly private credit is an interesting area as rates fall.
Perfect. And as well, so outside of the alternative asset side of things, more onto the public market side as well. I know we had talked about this previously, but with the dollars continuing to weaken into the back end of the year, we might see some of that shift towards US to international from a rebalancing perspective. Could you tell us a little bit more about that side there, Arun?
Yeah, so we are seeing more rebalancing towards non-US markets. As the US dollar falls, we're seeing higher dollar returns from European and Asian markets. And again, it's been a very long time. It's been almost 10 years since the US has actually lost to international markets. It's outperformed for the last 10 years. So as the dollar falls, or if the dollar continues to fall further, then you could make a case that moving more assets outside the US might make sense for many investors.
Great. Well, I think that that's it for today. We just wanted to put some time together in order for us to kind of go through what happened in the first half of the year. What are some things to look forward to in the back half of the year? So thank you very much for taking some time, Arun.
Thank you.
Anybody listening in, if there's any questions, please don't hesitate to reach out to either your advisor or our email inbox. General inbox is info@blackpointcp.com. And thank you very much for taking some time today.
All right. Thanks, Nico.